Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. The Russian invasion of Ukraine has introduced a variety of complexities into the financial markets and presented investors with an assortment of confusing signals. Joining me to discuss the three fundamental questions investors should be asking themselves is John Lynch, Chief Investment Officer with Comerica Wealth Management. John, it's great to have you with us. Welcome to Trade Talks.
Thank you, Jill. Delighted to be here.
You recently highlighted the degree to which equity markets have historically sold off in periods immediately surrounding geopolitical crisis events. What are the longer-term impacts?
Sure, Jill. We've typically seen the market sells off the first day of the incident, and then within 11 trading days, the market's down an average of 5%. And basically, Monday or Tuesday of this past week was when the market basically bottomed, and we started to see a very healthy rally this week. So we're pretty much according to plan, if you will, relative to historical averages. And what we have found perhaps more important than the surrounding weeks of the crisis event is that 12 months later, the S&P 500 has been up an average of 12 or 13%. So the message there for investors is to really focus on their long-term strategies and not be deterred by near-term events.
Let's discuss the three fundamental questions investors should be asking, starting with geopolitics. Will geopolitical events alter the path of US GDP?
I think that's really of primary importance because exposure to Russia and Ukraine, again, don't want to be dismissive of the human tragedy, but when you think about exposure to Russia and Ukraine for the US economy, we see it's next to nothing. Certainly the oil situation will have an impact where you have to somehow make up 4 or 5 million barrels a day. But beyond that, from a GDP standpoint, we just saw the Fed this week reduce GDP forecast to about, I think their number was around 3%, we'll call it. The consumption area is important for investors to keep in mind. You can really chart it if you look at when WTI went through, call it 80 or 85, WTI oil, that's when the consumer discretionary sector tightened up quite a bit, whether relative to oil or relative to the consumer staples sector, for example. So I think it's important for investors to still look at about 3.25% GDP this year. I do not believe that this crisis event in Eastern Europe will lead the US into recession. We are entering a Fed tightening campaign with full employment and with $2 trillion in consumer savings on the sideline. So that's a pretty firm backdrop for 2022.
And John, speaking of the Fed, for the next question investors should be asking, do you think any of this changes the Fed's plans for interest rates?
Yeah, the emotional aspect of it would suggest the Fed may want to tap the brakes a little bit, but when you look at 7 or 8% consumer inflation, 9 or 10% wholesale inflation, which is really indicative of what's coming down the pike, correct? So I don't believe it's going to alter the Fed's plan. They were very clear this week, 7 hikes in 22, an additional 4 hikes in 23. I'm not convinced that the 4 hikes in 23 may come to fruition. I know that's their intent. Hopefully supply chains will ease. Hopefully we'll get some clarity on that additional 5 million barrels. But I look back to the 1990s when the bond market acted as vigilante to slow the Fed down. It's very conceivable that after we do a handful of quarter-point hikes, and even if we see a few 50 basis point hikes thrown in there, it's very likely that the equity market could ultimately force the Fed to slow down before the dot plot would suggest.
And John, finally, the third question, and we know companies are grappling with supply chain constraints, cost inputs, margins. How will this impact corporate profits?
It's kind of curious. Corporate profits actually rose for 2022 in the first 10 trading days since the invasion of Ukraine, the Russian invasion of Ukraine. So I found that kind of fascinating. First quarter earnings will really play a very important role here because at this point, everyone's expecting about 5% earnings growth, maybe 10% sales growth. But investors are going to look beyond that, and they're going to want to see what the outlook is, what the visibility is from corporations on oil prices, on higher wages, and what that does for margins. As you know, margins have been hovering in the 12 or 13% range. If we go to 11 or 12%, I'm not convinced that's going to be enough to set the market back thus far. We are also looking at, even if the Fed raises 7 times this year, real rates are still going to be negative. So investors need to appreciate that we will be discounting record levels, growing slightly above historically average earnings, near record lows. So that still is a positive backdrop, we believe, for the equity market. Certainly a more volatile backdrop. I don't want to be dismissive of that, but we do think fundamentally it's still pretty good for profits in that 11 or 12% margin rate.
Any other leadership or relative trends investors should be aware of?
Yes, Jill, thank you. I think it's important for investors to recognize that surrounding geopolitical events, I think intuitively we want to believe that it's going to be an altering event from the path of leadership. And what we found throughout history has been, it's really been a resilient market, and it has been an opportunity for trends to be reinforced. I mean, we can go back to before Thanksgiving, before Omicron. We already saw value starting to outperform growth. We already saw the average stock, the equally weighted S&P, outperform the cap-weighted S&P. We've seen global interest rates marching higher. None of the commodity prices were in the ascent. None of those patterns have changed, and I think that's really important for investors to really, we had 70 new records last year, right? We had no more than a 5% pullback. When you see those 4 trends I just highlighted, I think that's very important for investors to appreciate the fact that the market was already discounting global cyclical recovery, and I suspect the market continues to.
All right, John, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.